this week's market update, sterling bears the brunt of Theresa May's week from hell, tax reform fears cast a shadow over equity markets and the dollar, and tension in the Middle East supports the oil price rally. Theresa May is clearly not a quitter, which is just as well because she's endured another week from hell. As ever, when politics starts to spin out of control, it's the pound which is bearing the brunt. Sterling fell by another 1% on Monday to just over $1.30 as investors weighed up another weekend of dire press coverage and the sense of crisis in the UK government intensified. The Prime Minister is trying to deliver Brexit while the governing Conservative Party descends into infighting verging on civil war. This follows a week in which 2 cabinet ministers resigned, the Foreign Secretary faced calls to quit after a most undiplomatic intervention in a consular dispute with Iran, and a leading Sunday newspaper said that 40 Tory MPs had agreed to sign a letter of no confidence in Mrs May. This cocktail of concerns comes as a key piece of Brexit legislation, the Withdrawal Bill, is due to be debated in the House of Commons. With Britain's EU partners demanding clear commitments within the next 2 weeks if talks are to shift from divorce to more substantive trade negotiations before the end of the year. Meanwhile, the cracks in the government widened with another Sunday newspaper revelation that Boris Johnson, the Foreign Secretary, and Michael Gove, the Environment Secretary, had written to the Prime Minister last month insisting that she pursue a hard Brexit strategy. Following on from the sackings of Defence Secretary Michael Fallon and International Development Secretary Priti Patel within a week of each other, the UK government now appears in a state of crisis. The fall in the pound is relatively modest, but it shows the extent to which UK financial markets are vulnerable to political upheavals. Monday's fall in the pound was the biggest since a 1.5% fall at the beginning of November after the Bank of England's dovish hike in interest rates that failed to convince any observers that interest rates would remain anything but low for the foreseeable future. Politics will remain in the spotlight for the next 10 days or so in the UK, with Chancellor Philip Hammond's budget due to be unveiled next Wednesday, 22nd of November. The Chancellor faces a huge challenge in balancing the books as a £26 billion cushion he built up a year ago evaporates in the face of disappointing productivity growth expectations. Lower productivity leads to lower corporate profits and so to lower tax revenues for the Chancellor. That makes his already delayed goal of eradicating the UK's budget deficit by the mid-2020s look ever more fanciful. His challenge is made doubly difficult by the splits in the Conservative Party, with many pro-Brexit MPs looking to undermine a Chancellor they see as too focused on a soft exit from the EU. One possibility being weighed up by the Chancellor is a shake-up of VAT rules for smaller companies. This could raise up to £2 billion a year for the Treasury, but it risks a business and political backlash. The Chancellor is looking to sharply reduce the threshold for small businesses being obliged to charge VAT to their customers. Currently it's £85,000, it will come closer to the EU average of £20,000. The Chancellor will have at the back of his mind this spring's attack on the self-employed with a national insurance tax shake-up, which outraged many of his backbench colleagues and which led to an embarrassing U-turn in the days after the budget. Other measures under consideration include measures to help first-time buyers, increasingly priced out of the UK's overpriced housing market. A cut in stamp duty is on the cards, although a more radical new housing policy, which was hinted at by Theresa May's promise to fix the broken housing market, looks wide of the mark. For investors, the key focus will be on pension allowances. There's speculation that the annual £40,000 contribution allowance could be cut, while the lifetime savings allowance of £1 million is also in the spotlight. Dividend tax, which enjoys a £5,000 tax-free allowance, could also be changed to net more revenues from investors. The rate is already due to fall to £2,000 in April 2018. Elsewhere in the UK, inflation and wage data this week will cast further light on the health of the UK economy. With inflation hovering around the 3% mark, it is likely that Mark Carney will soon be writing to the Chancellor explaining why prices are rising at more than 1 percentage point above the bank's 2% target. Wage growth is certain to be well below the rate of price rises, putting a squeeze on consumer confidence. If Brexit is affecting the currency markets, equities are focused more on the tax reforms across the Atlantic. More specifically, the lack of tax reforms in the short term, as it looks increasingly difficult for President Trump to get his tax reduction proposals through Congress. Specifically, last week the Senate unveiled a rival plan to the bill currently passing through the House of Representatives. The Senate plan differs in a number of regards, most notably in the start date, which would be a year later in order to save money. Congress is battling to stay within a self-imposed budget deficit of $1.5 trillion over the next 10 years. The delay is likely to be a disappointment to chief executives who argue that America's high corporate taxes are a hindrance to their global competitiveness. Investors too will be disappointed because lower taxes feed through to higher profits and so to more money for companies to distribute to shareholders via dividends or share buybacks. This was the key driver of last week's downturn in the US equity market, the first weekly decline in 2 months. Equity investors have driven prices to new all-time highs on the back of hopes for tax cuts. But as Treasury Secretary Stephen Mnuchin said recently, failure to deliver the hoped-for reforms could blow a sizable amount of market froth away. Elsewhere, global markets were hit by a range of different factors. In the UK, retailing stocks dragged the FTSE 100 lower, and the UK benchmark recorded its biggest weekly decline in 2 months. European stocks responded unfavourably to some poorly received earnings reports, and in Japan, which hit a 26-year high on Wednesday, shares dipped but remained in positive territory for the week as a whole. Investors continue to focus on GDP growth, rising inflation and positive follow-through to Shinzo Abe's decisive election victory. Central bankers are in focus this week as the Big Four, Janet Yellen, Mark Carney, Mario Draghi and Haruki Kuroda get together in Frankfurt to discuss the communication of central bank monetary policy. While that might sound like a pretty obscure topic for discussion, the success or otherwise of attempts to guide the markets on interest rates has been a key source of volatility in recent years. From Ben Bernanke's taper tantrum in 2013 to Mark Carney's forward guidance and even Alan Greenspan's purposeful obfuscation in the 1990s, central bankers have used clarity or its lack as a key policy tool for years. Mark Carney was famously branded an unreliable boyfriend for his failure to follow guidance with actual action. On the flip side, Mario Draghi's promise in an off-the-cuff remark in 2012 that the ECB would do whatever it takes to save the euro were arguably the most successful interventions by a central banker ever. He effectively ended the European sovereign debt crisis with those 3 words. Draghi's job has certainly been made easier in recent months by the Eurozone's ability to return to meaningful economic growth, and we should get more insight into this later today. Germany, the engine room of the European economy, releases third quarter GDP growth data. Germany's labour market continues to perform strongly with good growth in industrial production. Unemployment is at a record low level and household spending expected to remain robust. Growth is expected to hit 0.6% quarter on quarter, and that takes the annualised rate to 2.3%. Not such good news is expected from Japan, where analysts expect a slowdown in annualised growth from 2.5% to 1.3%, although that remains above the country's long-term growth rate. It would also be the 7th consecutive quarter of positive GDP growth, and that would be the longest run of consecutive growth since the 8-quarter streak from 1999 to 2001. And finally, in other markets, the oil price remains at elevated levels by recent standards. Brent crude is over $63 a barrel. It's risen by more than 40% since the summer on the back of better supply-demand fundamentals and, more recently, the ratcheting up of tension in the Middle East. Growing friction between the region's 2 powers, Saudi Arabia and Iran, have risen to the surface over the past week, following the apparently forced resignation of Lebanon's Prime Minister, a rocket attack on Riyadh from war-torn Yemen, and a major purge of senior political figures in Saudi Arabia.